Diversification or concentration? Government involvement or let the free market reign? Is there a shortage of capital in the early stage investment sector? These are some of the myths, some of the questions that we're going to answer in this conversation today with Rowan Simpson. He was involved really early on with companies like TradeMe, Timely, Xero, and Vend. He's written a book to be released on the 25th of February called How to Be Wrong, a Practical Guide for Startup Success. I hope you enjoy this one. Let's get started. So let's start out with Flat Hunt to where you're at right now, everything in between. Go.
Sure, not very many people will have heard of Flat Hunt. That was my startup in 1999, which makes me sound very old. 1900 as my kids call it. And I ran that for about 6 months, got it to a steady state, and it was eventually then acquired by TradeMe and became TradeMe Property, which was my, I guess, route into being one of the early part of the team that built TradeMe in the beginning. So I worked on TradeMe for a couple of years. There was a period in the middle where most of us who were in that early team left and spent some time in Europe.
Right.
Maybe we'll talk about that in a bit more detail. But came back to TradeMe in 2004. The business was sold in 2006. Most New Zealanders who were paying attention at the time will know that story. We sold to Fairfax Media, a big Australian company, for $750 million. I continued working there for about a year before I was shot at by Rod Drury and Hamish as they were starting in Xero. And so jumped ship, took the opportunity to be an early investor and exec at Xero as we were going through the very early IPO on the NZX. And yeah, what I've done since then is more on the investor side. So 2010, I was one of the original investors in a company called Vend, which we sold in 2021 for 350 million US. 2012, I was the first investor in a business called Timely, which was also sold in 2021 for 100 million plus. So yeah, I've had this really unique kind of opportunity to be hands-on in the beginning of these businesses, which have grown to become big, successful companies. And it's given me a different perspective because I got to see them in their messy, embryonic early stages rather than sort of retrospectively as successful companies. It was certainly not true for any of those that they were obviously successful then.
And how did you then spot, or how did you know that you were working with success? Because to me, that kind of sounds like you just hop from one success to another, to another, to another.
I mean, when you string them all together, it's easy to kind of draw that narrative. But the experience of working on those companies in the moment was not, amazing success. Often the exact opposite. Like the books that I've written is called How to Be Wrong. It's kind of a bit of a clue to the experience of those companies is the hard grind and lots of missteps, lots of mistakes, lots of scar tissue from all the things that you don't know when you're first starting out, and you can only learn by trying.
Like your book is How to Be Wrong, but it's not like your decisions were wrong. You ended up taking these roles and investing at just the right time with the right companies, right?
Yeah, that's right. And I guess one of the things that I'm hoping people will take from the book as they read it are some of those patterns, because there are common things that you can extract. The lessons that we learned from making those mistakes in the early stages of all of those companies have informed things that we got right in subsequent businesses.
Sure.
You have to have your eyes open to that. You have to be really conscious about measuring your results. You have to really have the mindset that you're probably not right first time, and be willing to, see that and adjust quickly.
Sure.
And you have to be honest. Like you have to be internally honest, at least, about what is and isn't working.
And so after you went through all those things, obviously there came a time where you almost started to sit on the other side of the table, right? Instead of actually working in the startup, you were investing in startups, plural, right?
Exactly.
And that's kind of what you're doing right now, right?
It's still what I do now. Yeah. I mean, I sort of stopped in 2012, but I've continued to invest in these young businesses ever since, and still today. And I mean, I take a particular approach to that. I don't have a large portfolio of them. I have a very focused portfolio of them that I try and work with hands-on and closely and help them as much as I can. But that's how I fill my days, even still. So.
Yeah. And to go from TradeMe to Xero to Vend to Timely, or Timely to Vend, that's amazing, right? Like those were amazing companies to be a part of at the stage that you were. And I guess where I'm going with that is was that a unique period of time in New Zealand history where that just happened?
Yeah.
Or is this something that is an ecosystem that, like any biological system, it requires a few things to be functioning for it to actually be thriving?
Yeah, sure. I mean, retrospectively, I think you can sort of explain most of those companies and why they were successful. Like both TradeMe and Xero were Wellington businesses, and there was a moment in the early 2000s where there was a critical mass of people, I guess, who wanted to work on those businesses, but also enough capital to get them started. You know, a lot of the initial capital into Xero was the exhaust of TradeMe. We see that pattern repeat over and over. This is one of the patterns that I think you can extract and generalize, is that you know, each generation builds on itself. So the reason I was able to invest in Xero was because of the success of TradeMe. The reason I was able to invest in Vend and Timely and others is because of the success of Xero. And that's how an ecosystem grows. I think folks who kind of take a more bureaucratic view often talk about trying to build an ecosystem. And I like to say an ecosystem grows from the bottom up, one company at a time. And yeah, that's what we've seen. And I would say actually sort of the counter to what you just suggested, like not only was that not just a special moment in time, it wasn't even the high point. Like I would say the ecosystem of companies today in New Zealand is as strong as it's ever been. Like there are now more successful companies than I think probably we've ever had. And there's a really easy reason or easy explanation for that, which is a lot of those folks who are starting these businesses, a lot of the folks who are investing in these businesses have been successful in other companies, and they're recycling that capital and they're recycling that knowledge and experience either as founders and operators or as investors and advisors or all sorts of other roles as well. And that's how an ecosystem grows.
It makes sense, right? I guess you could call it a market, maybe. Like, and an
I
analogy
mean,
would be the
yeah,
housing
I used
market.
to push back against the word ecosystem because it was often kind of adopted by folks that I disagreed with, I guess. But I think it is actually the right word. It's just the collective noun of startups. Now, if you think about an ecosystem in the natural world, you know, you have the trees and the plants that grow in that, but you also have the environment that they grow in. And so you need a bit of both, but really the thing that really counts, the thing that matters in the end is the companies.
Okay. Can you describe to me the like 30,000 foot overview of what that ecosystem actually looks like? What does the startup ecosystem look like, specifically in New Zealand, but even in the broader context, like globally, what does it
Yeah.
typically look like? How does it differ?
Yeah. And I mean, I think if you ask different people, you get very different answers to this because everyone will have their own perspective on it. So my perspective on that is very founder centric, company centric. So I tend to look at the companies and the people who are working on them and investing in them directly. But there's a whole layer, an umbrella, if you like, that sits above that of entities and organizations and government organizations in some cases, which are established to try and foster or encourage or help those companies and those founders and
Like
investors
fertilizer
grow.
type thing, right?
Yeah, right. And
Or,
so you'll hear expressions like incubators or accelerators or venture funds or um, even dragons dens, if you want to drag more to the reality television end of the spectrum. Innovation showcases, innovation hubs. If you're a real estate guy, you know there's a lot of aspects to that kind of derivative layer, which is what I call it, which you know sort of has proliferated not only in New Zealand but everywhere over as the number of these young companies and the size of these young companies has grown.
so the doers, viewers, participators, and they're all kind of derivatives on a base layer, I guess, if you like, of actual innovation.
Yeah, so I mean, I like that expression, derivatives. Maybe it's just my inner math geek coming out, but I think it's a nice way to kind of categorize and understand how close somebody or some organization in that ecosystem is to what fundamentally matters, which is the company.
Yes.
And so you can think of, if you're an advisor or you're an investor, you're first derivative, one step removed from the company. If you're running a support program like an accelerator program or an incubator or an innovation hub, you're second derivative really, because you're even one step further removed. If you're a bureaucrat funding an incubator or funding an accelerator, third derivative.
Right.
And you can just keep going up. Like, by the time you get to be, we have seen in New Zealand, for example, funds of funds created where the government has tried to support venture funds to then invest in companies. And so if you think of yourself as the government investing in the fund of fund, which then invests in venture funds, which then invest in companies, you're getting to quite a high stack of derivatives. Yeah.
Okay, cool. I love that explanation as well, though, right? Because I think as investors as well, we can also be like that. Like we can get out there and we can start business.
How close to the fundamental are you is a great challenge for anybody, because if you find yourself working in the second or third or even fourth derivative, get closer to the source.
That's interesting, because I just think about like index investing versus individual shares versus starting your own business. Right. You're getting closer and closer to the source of wealth, which is, well, it's basically creativity and bringing something out of nothing, isn't it?
Yeah, that's right. I mean, that's fundamentally that's what startups are about, is trying to, as you say, build something where it doesn't exist yet, but the potential exists.
So can you just help us to understand the difference between terms like startup, early stage, venture, angel? They're all kind of these words. How can we organize them to make sense for people that are listening, or for people that might want to invest capital as close to the fire as possible?
Sure. So, I mean, startup is a much abused term. So let's start with that. I mean, I like to split that into two broad buckets. There's the early stage, and then there's the high growth stage. So the early stage is where normally one or two people have an idea and they think they can make that thing exist in the world. And the questions that they need to answer in that stage are quite specific to that very early stage. It's much more about ideation and building and proving the concept has potential. And then some, but not all of those early stage startups will become high growth startups. And that's where some of these other expressions like venture or angel or other things will come in. So, at the point where you have an idea that's shown its potential and you need to scale that, then you're likely going to need some funding of some kind or other to do that. So that's what, the venture is kind of just a shortened version of venture capital. It's a subset of private equity if you kind of think of it that way. But that's, people who are willing to invest capital at that point where a company is ready to become a high growth company. And if you're a high growth startup, you've got an entirely different set of challenges. They're all scale challenges. Like, how do you expand and how do you manage that expansion, which is often rapid when a company really is in that stage, without the wheels falling off.
Right. And every industry will have different dynamics, I guess, around how fast you could scale, right? Because of
and I mean, sometimes capital is the constraint, but in my experience, at least working with these companies that have become high growth companies and navigated that phase of life, raising a lot of money only reveals the next constraint, which is finding some way to spend it.
Okay.
And so if you think about that, all of the problems that a high growth company have typically are related to people. How do you hire the people that you need to help you grow the business?
Okay. And technology is the language spoken pretty much, well, from where I said, it feels like, if you're investing in early stage venture, it is going to probably be a technology.
Often, because, I mean, I'm old enough now to have seen a few different waves of technology break. So TradeMe was an internet. It was built as the internet wave was breaking. Xero IPO'd around the same time as Steve Jobs launched the iPhone in 2007. Crazy. So, we saw that mobile wave have a huge impact on the world. And we're seeing new waves now with crypto and with AI and other things. And time will tell how those waves play out. But I mean, as a result of the disruption that those waves always create opportunities for new companies. So it's easy to kind of end up with that bias that they need to be tech companies. And interestingly, I have a slightly different definition of that. I think it's 2025. Every company is a tech company. Like if you have engineers on your payroll, that should no longer be remarkable. If you don't have engineers on your payroll, you should probably be asking why not. And so I think just defining yourself as a tech company is not really saying anything interesting these days. I think it's probably much smarter for you to think about the sector that your customers are in and define yourself that way. So Timely is a great example of this. This is sort of where I learned this lesson in the beginning of Timely. So Timely, for those who've never heard of it, is a platform for health and beauty businesses. So hairdressers, salons, spas will use Timely to manage their bookings and their customer database and payments and those things. And in the beginning, we were product, we were engineers. So we thought of ourselves as a tech company and our customers were in the health and beauty sector. And over time, we realized that that was a mistake. We were wrong about that. And we adjusted our thinking to realize that we were part of the health and beauty sector and our product was technology services to those customers. And it might seem subtle, but that was a really fundamental shift in the way that we thought about ourselves and the way we sold our product to what became our peers in the sector, if that makes sense. So yeah, I mean, I think it's true to say that many startups will define themselves as tech companies, but I think you're probably better to try and cut through that and work out what they're actually building and who they're building it for.
Interesting. If technology is a wave, it crashes, and when the water moves around, it probably moves to where the water can move really easily first.
Sure. Yeah.
And then it'll permeate other areas later on, right?
Yeah.
And maybe cause some erosion in the process, which makes it easier for the waves to crash elsewhere.
I love it. I love a good metaphor. This one's getting better the more you talk.
Man. So. But like it seems to be playing, technology seems to be playing in a certain realm. Let's say, hey, Web 2, right?
Yeah.
It seems to be playing in the internet realm, or it has played to a certain extent.
Yeah.
And the harder to reach places, like in my area, financial services, it feels like blaming on regulation, right? I love blaming everything on regulation, but it feels like the technology it struggles to get into the cracks somehow because there's rocks in the way, right?
Yeah, I mean, a good example of that in your sector would be open banking. Like some parts of the world have really embraced that, and you've seen lots of innovation happening in those spaces. Other jurisdictions have been a bit more hesitant, and as a result, there hasn't been quite the same opportunity for startups to disrupt. A startup is a disruptive thing. Like it's trying to create a business where one doesn't exist, and that's often challenging to the incumbents. As a result, so Trade Me was terrible for the newspaper classifieds. Like we disrupted their business, and you can kind of see that pattern repeat with all of these companies.
Yeah, it's creative disruption, right? Creative destruction.
Yeah,
and it destroys as it creates, makes obsolete. I think I heard you in a presentation once talk about how it's technology and then it's stuff, right?
Yeah.
Technology turns into stuff
very quickly, right? And I think I mean what we would call technology, my kids don't consider technology. They just take that for granted. And so like that happens quickly with things. And actually I've been using that same example recently with AI. I have a theory of AI, which is when it's never going to be realized because AI will always be the bits of that technology that don't work yet. Like once it works, we'll just call it what it is. So a great example of that is autocorrect. I mean, autocorrect has been a feature of our phones for a long time. And for most of that history has been kind of a joke. Like it has never really worked well. And then all of a sudden, in recent times, it started to work much better. Because now it's using AI under the surface.
Now it's just stuff, right? It's just we just accept it.
But we just call it autocorrect. We don't call it AI.
Correct. Yeah.
And so we'll see AI, I think, work its way into lots of the features that we take for granted, lots of the stuff, and we probably won't even call it AI.
So instead of labeling it what it is, it's more what it does.
What it does, right?
Right.
Which is, again, back to that timely example. It's not thinking of technology as the interesting thing. It's thinking about how the customer uses that technology, what sector they are in.
That's good. So one of the things that was evident in, I think, early part of the book, the parts that I read, which was this part in particular, was referring to yourself as the quiet one.
Right, yeah.
And it's a badge that I didn't pick up the fact that you're ashamed of that badge, being the quiet one.
I'm not ashamed of that badge, no.
Good.
I would own it.
Good. Well, so tell me about that, because we see this probably everywhere, right? Like, how would you describe what a quiet one is? What's the opposite of a quiet one?
So the original idea that I had for the quiet one actually came from the ad in the late 90s that Apple put out, Think Different, which they celebrated the crazy ones in that ad, if those of us who are old enough to remember that. And I always like to kind of imagine the opposite of things. And so it made me think, okay, I'm not a crazy one. I don't fit any of those descriptions in that advert. But I feel like I still have a role to play in these companies and these businesses as they grow. So how would you sort of describe my role, if you like? And so quiet one was a counterpoint to crazy one. But again, it's a pattern that you just see repeated over and over and over again. I mean, an amazing example of this from the finance world would be Charlie Munger, who, like Warren Buffett is called the greatest investor in the world. Nearly all of his investments were made in collaboration with Charlie. And Charlie was, the quiet one in that partnership, but equally a billionaire in his own right, if you like. An example from the entertainment world would be Bernie Taupin, who was the lyricist for Elton John, like this, really extravagant singer who's very widely known. But all of his words were written by Bernie Taupin, and 50% of the songwriting credits at least go to him. So yeah, and you just, whether it's science or arts or entertainment, business, finance, investing, like you see this pattern repeated over and over. And startups are no different. So it's very common for one person's name to be attached to a successful business or a jury of Xero, for example. Most people who know the Xero story even won't know Hamish Edwards, who was Rod's co-founder in that business. So you don't even know the name of the second person, let alone all of the other people that were part of that team. And
why do you think that happens though? Like, why do you think that in a team where there's obviously clearly capable people going on here, why do some kind of just not get picked up by the general public?
I mean, I think the media has a role to play in that. Like, I think it's an easier story to tell that it's one person, one lone genius. It's more complicated and messy to say, actually, it's this team of 50 people and, let's go through them all. Like that's nowhere near as succinct and sharp. So that's the way the narrative forms.
Yeah.
But it also serves the quiet ones in some sense. Like, I feel like over the years, it's helped me much more than it's hurt me to not be, in the spotlight, constantly having to deal with the pressure of that. I've been able to operate, much more effectively as a quiet one.
Yeah.
Away from this. When I talk about these companies that I've had the privilege of working on, people are often surprised to discover that I worked on any of them, let alone all of them.
Yeah.
And so
do you ever kind of feel like, that's a bit unfair, I got no credit? Do you kind of feel shortchanged?
I like to think of it as leaving the credit for people who care about that bit. So
okay, so you're genuinely not turned on by the attention and the accolades.
There's a great Bill Murray quote which I quite like, which is, he says, when people say they want to be rich and famous, I recommend that they try just being rich first.
Right.
And that's, I like to think of it that way. Like I have a great life. I've been very successful. I don't feel like not being known has let me down.
Yeah, if you're going to be famous without being wealthy,
right, which is more common than not. Like if you look at people who are genuinely famous, often they don't have the other half. So
cool. Let's talk about diversification versus concentration. And I'm just going to read this quote directly taken from the book. The term diversification was first coined by Peter Lynch. He was describing a situation where risk is already very low, so adding additional assets to a portfolio doesn't help. The same logic applies when risk is already very high. Diversification protects wealth, but concentration produces wealth. So help me to understand this, right? Because if we're thinking about early stage investing, we are talking about ventures here that are very likely to fail.
Extremely risky, yeah. Or uncertain is probably a better way of doing it.
Yeah. So like in my mind, yeah, that's right. Uncertain results instead of definitely you're going to lose all your money.
Yeah.
But logically, I'm just thinking, well, yeah, you sandwich, say, 10 opportunities instead of just one. Yeah. That makes sense because all it takes is one to offset all the money that you would have lost in the failures.
Yeah.
So, take me through the logic. Why is this diversification in startup?
So you have to understand the spectrum of possible ranges of outcome. Like the difference between investing in a public company and investing in a startup is if a public company has a bad year, their share price can drop. If a startup company has a bad year, they can be out of business. They can go to zero. So like the lower end of the range of possible outcomes is zero. And actually, if you plot them, probably the most likely outcome. And at the other end of the spectrum, the potential returns are eye-wateringly good. Like to use an example from the book, the original investors in TradeMe invested $100,000, got half the company. When we sold the business, they would have got $300 million plus for that $100,000 investment.
So for every $1, there was 3,000 back.
Exactly, yeah. And so like you struggle to find investments that produce those kind of returns. So like there's this amazing range from zero to eye-watering of possible outcomes. And for any individual investment you make, the most likely outcome is still zero. So investing in 10, the most likely outcome is still zero across all 10. And yet all you've done by having spread your bets across 10 companies is
limited your upside
by a whole order of magnitude.
Yeah.
And so, the reason that people are drawn to that idea of picking 10, I think, is because they don't back their own judgment. They're not sure that they can pick the one winner.
Mm-hmm.
And so they think that by spreading their bets, they increase their chances of picking a winner. When actually, I would argue they probably don't increase their chances of picking a winner at all.
Because the risk is already high, like you say. So adding additional securities to the mix doesn't increase your odds of a payout. It's just you're just pouring more money after that. Okay,
Right.
that's
And
fascinating.
also, like, I mean, the other constraint when you're an investor in these companies is time.
Mm-hmm.
Like what my experience of being an investor, like the money I've invested is useful to the founders that I'm investing in, for sure. But the time that I've committed to that and the advice that I can bring to the table and the help that I can give them as they go through those early stages,
Yeah.
I think is probably arguably much more valuable than the capital. And so again, if you spread your bets too thinly, you just limit the ability that you can help each of those companies.
Sure. But is that a strategy that you're in the fortunate position to exercise because
Yeah,
of
of
your
course,
background?
because of my
Yeah.
experience. I mean, that's one of the advantages that I have. And actually, as we'll hopefully talk about, one of the reasons why I get to invest in the best companies. But for somebody just thinking about getting into this type of investment, there is the equivalent of an index fund in this space, which is venture funds. So a venture fund basically just collects together the capital of a bunch of limited partners, and then an experienced general partner of that fund will decide where to deploy that capital.
Yes.
So for somebody who wants exposure to this asset class, if you like, the smart thing to do, rather than spreading their bets across 10 individual investments that they've made themselves, is probably to find a great fund
I
manager
see. Right.
and invest in the fund.
That answers another indirect question, which is why wouldn't someone who doesn't have the experience but wants to get the fruits of this
Sure,
sector,
yeah.
why wouldn't they use diversification? And you've already answered that, but I guess the way that they would start would be to use a fund where it's being managed by someone from the inside who actually knows
Sure, yeah.
the landscape.
And I mean, that doesn't preclude them working with one of the companies that the
Mm.
fund invests in if they're chosen to.
That's right. Well, it's a core satellite approach to it, right? Like when you feel confident, you would
Right.
double down
Right, exactly. Yeah.
into one concentrated bet.
Yeah, nice.
Right?
I haven't thought of it using that language before, but you're 100% right.
Okay. So yeah, because there are a lot of those products, we'll say, that feel like that's with the way that things are going to go.
Yeah.
And I think you're right. It's like narrowing the range of possible outcomes so that the everyday investor can actually access it. And I just mean retail, right? Because there's more money out there, but it's just not practical, I think, to scale.
Of course, yeah. And I mean, there
knowledge,
are downsides to investing in funds, as like this is generally true in finance. You'll have management fees, and you'll have fund manager risk and all those things. But as a way of getting exposure to that class of asset without all of the downsides that I'm describing in diversification, then that's, I think, a smarter choice for most investors.
Okay, that's cool. Okay, so kind of like continuing on the theme of this, in terms of what the landscape is, a couple of methodologies: concentration versus diversification via funds as a strategy to get exposure to it. Where does the money come from? So if we think about capital or money entering into this ecosystem, where is it coming from? Is it coming from people like you who've exited in the past? Like, is that the majority of capital? Or is it institutional? And is it super fund, KiwiSaver providers? What does that story look like?
So I think it depends a lot on where in the world you're asking this question as well. But let's talk about New Zealand as the context I know best. The venture fund layer, if you like, of the ecosystem is still relatively new in New Zealand. It's only in relatively recent years that's really found its feet and gotten established. And so those funds, it's substantial. There's hundreds of millions of dollars of venture capital funds available to invest in New Zealand. But compared to Australia, for example, where there are billions of dollars of investment in venture capital funds ready to be deployed. And so thinking about the difference between that, like the investors into venture funds in New Zealand have predominantly been high net worth individuals or family offices or people who want exposure to that asset class, I think. We're starting to see some of the KiwiSaver funds get exposure to that. The government super fund has invested in a couple of New Zealand venture managers. So that's starting to build over time. But if you, again, go to Australia and compare that, the big Aussie super funds are significant investors into the venture funds, which gives them a scale that's kind of, it's much, much more substantial. And so it is true that the exhaust of one successful company is capital that can be reinvested into the next generation of companies. And that can happen at all the layers, whether it's, a proper early stage investment by an individual at the very beginning, or whether it's an investment in a fund or other things. That's
And where's it going? Is it more likely that sovereign wealth funds will start to allocate towards this in the hunt for yield?
Yeah, I mean, there's a lot of debate in New Zealand about how we would grow the capital base, And I mean, the obvious answer to that for me is it sits around our tentative approach to compulsory superannuation in New Zealand. Like all of the markets in the world where there are substantial venture funds have all of those big retirement saving funds often sitting behind them. So that's hopefully the path for us too as we continue to kind of mature that part of the ecosystem.
Okay. So kind of loosely connected to this idea in terms of capital coming into the ecosystem is the role that government plays. And does the government in New Zealand or in most places where this operates, are they actually helpful in terms of orchestrating or bringing new capital to the scene?
Yeah.
Or is it at risk of actually kind of creating false signals, like distorting the free market so that there's a misallocation of capital?
Yeah. And I think, again, the answer is very different depending on where in the world you're asking it. And I think what that teaches us is that context is actually critical to this. So the canonical example would probably be Israel. So in the 90s in Israel, there was a scheme called Yozma, which was their attempt to bootstrap a venture capital layer of their ecosystem. And they were incredibly successful at doing it. So with a relatively modest government investment, they seeded some funds, and those funds backed some really great companies, and the success has built on itself and snowballed since then. So relatively soon after the government invested, they were able to kind of step back from that and let the market run.
So they're a catalyst or a
They
Kickstarter.
were a catalyst, and there were some other really consequential contextual elements which led to that success, not least being the immigration into Israel from Eastern Europe. So there was a huge influx of scientists and engineers from Russia and other Soviet countries, which provided the raw materials in terms of people to build those companies and build those funds.
Right.
They also have compulsory military service. One of the first questions an Israeli investor will ask a founder is, which division did you serve in? Because depending on your answer to that, it will determine their interest in investing in your venture. If based on the experience that you had during that compulsory service time. So both the immigration and the military service are contexts that we will never recreate in New Zealand. The New Zealand government basically shamelessly copied this model starting in 2002. The Venture Investment Fund was set up with the exact same structure. Our results have been basically the exact opposite of what Israel achieved. None of the original funds that the government invested in even took the cash back option. There was one fund, Valar Ventures, which was an investor in Xero and in Vend, actually, which did, but they were kind of reversed into the scheme a bit later. It was pretty controversial at the time. So yeah, we've been kind of bumbling away for 20 plus years trying to, or hoping for that outcome in New Zealand without much to show for it, unfortunately.
Right. And I guess it's like you're privatizing the profit, but you're socializing the initial startup costs.
Sure.
Right?
Yeah. I mean, there was like that particular scheme was a fund of funds model originally. So they were really trying to catalyze, to use your word, venture funds. And ironically, venture funds now exist in New Zealand, but they weren't catalyzed by VIF so much as catalyzed by the exhaust of successful ventures.
Right.
And yeah, it's a pretty damning track record. Like, there have been some really great companies created in New Zealand during that time, including some of the ones that I've written about in the book, but there are others as well as that.
Right.
As far as the results show, the government fund hasn't invested in any of them. So
right.
like judgment still matters a lot.
Merit, right, is kind of important in this context.
Yeah, and I mean, like if you're a fund of funds, you're really relying on the judgment of the fund managers that you back.
Yeah.
And empirically, we didn't back the right managers.
Right.
The idea was right, which is, can we accelerate that and fuel it kind of artificially? But the execution of that, unfortunately, hasn't been great.
Okay. So tell me, though, the importance of pain, like going back to your experience in the startups, like you mentioned, your experience with TradeMe, how there was a point where everyone kind of just took off to Europe and then came back and things were just firing amazingly. Yeah. So what is it about pain that is almost necessary to help something get off the ground and prove itself?
Yeah, I think we have to be a little careful because failure, unfortunately, is over glamorized in the startup world. You'll often hear people advise to fail fast or to kind of own their failures. And I don't know, like I've worked on ventures that have failed, and it's pretty painful when they do. So I don't really think anybody should be advised to have that outcome. it's a pretty terrible way to learn as well. It's quite a painful way to learn. What I think is a much smarter way, sort of mindset around that pain, is like lots of little small failures constantly. So like assume you're wrong and like be open to be aware to all of those possible ways that you might be wrong. And as soon as you discover that, adjust quickly. Be honest about it. Don't pretend otherwise. Be honest about it and adjust quickly. And like if you do that every day, hundreds of times, then those lessons build on each other and accumulate. And
is that what you mean when like how to be wrong rather than how to fail? Is that what you're getting at?
It's 100% what I mean. Yeah. Like, so, there's only three ways to be wrong. Is to not ask the question. So don't even measure, make a mistake, make an error.
Yeah.
Like don't be open to the possibility that you're wrong. Or the last way is to lie. And that might sound facetious, but actually it happens all the time in startups because it's uncomfortable to admit that something's not working. And there's easy things you can do to avoid all three of those ways to be wrong.
Okay.
And when you do, you actually give yourself a chance to be right.
And this is probably connected a little bit to one of the questions I want to ask you, which is, what is the deal with New Zealand's tall poppy syndrome? And for those that are listening overseas, maybe just define what that is. I'm sure every country probably has a version of this.
Different countries do. Yeah, I'm interested to hear your definition of it, though. So explain it back to me.
Yeah, okay. So like and it took me a long time to really understand this because when I first came here 25 years ago, people were talking about this. And I didn't really understand this. And even when I had some successes in my own life that I wanted to talk about, I didn't necessarily feel that for myself. And I don't know if it's just because I was an outsider or not, but it kind of feels to me like a sense of false humility where there's just it's just uncomfortable being out there and a leader in any area. And but I don't know where that comes from. And I'm fascinated if it's a cultural thing. Like, does it go back into New Zealand's history? Is it where our ancestors have come from? I don't know. But I find it quite interesting.
I'm fascinated by tall poppy. We could go deep on this if we had more time.
Yeah, hey, let the roots of tall poppies go deep.
The original version of tall poppy actually was something quite different, which was like a powerful leader cutting down challenges before they could become a threat. But yeah, I mean, it's a common expression in New Zealand and Australia. The Nordic countries have their own version of this, which they call the law of Jonti. But it's kind of a similar concept, which is don't get too far ahead of yourself. And I don't know. I don't have that same kind of innate fear of tall poppy, I guess, that a lot of people describe in New Zealand. And my evidence for that would be all of the successful people who are often celebrated in New Zealand for their successes, from sports people to artists, musicians, all sorts of people, scientists. Probably our most famous person, the guy who lives on our $5 note, a mountaineer. All of these people have been celebrated for their achievements. And I think the thing that sort of makes that distinction is how they celebrate their success. Like, we really like the All Black that scores a try, puts their head down and runs back to halfway, ready to take the next kickoff. Like, I don't think we would tolerate that sort of NFL style touchdown celebration from an All Black. And I think that's good. I think that's sort of, as you said, is culturally deep in New Zealand, that's what we prefer. But humility is not a bad thing. Like, I think, any success that anybody has, and I'd include myself and all the people that I've worked with on this, is never an individual success. It's always a team of people that contribute to that, even if one name is attached to it. And so one person kind of celebrating their achievement in that sense is a little bit fake and probably is not what I would encourage. And then looking at it from the complete opposite perspective, like, people do get cut down in New Zealand. I don't pretend that doesn't happen. But often those folks are the ones who have kind of pretended that they're successful before they've actually done it. And this happens a lot in the startup world, especially, where people are often encouraged to fake it till you make it. And so, you'll find young founders get up on stage at innovation showcase events and kind of pretend that their company is much more successful than it is, hoping to get investment. And that gap between, the internal reality and the external perception always closes eventually. And when it does, it can be quite painful in New Zealand because people aren't very tolerant of that sort of showboating ahead of achievement.
Why are they not tolerant?
I think for the same reason that we celebrate the humble, successful person, right? It's like we kind of see those people as getting ahead of themselves. Like, you haven't actually done anything yet. Keep your head down and do it. and then we'll celebrate you. I don't think we should feel ashamed that that's our cultural preference. I think, I tell the story in the book of going to the States with Vaughan, who was the founder at Vend, and trying to raise money from US investors. There was this very memorable moment. We walked into a venture capital firm on Sand Hill Road, and the investor said to Vaughan, how's it going? And Vaughan said, pretty good. And you could see this guy's face just drop. Like, to him, pretty good meant terrible. And like, to a New Zealander, pretty good means amazing. Like, pretty good means pretty good. But yeah, it's like there's a cultural disconnect there where, what he wanted to hear from Vaughan was, things are incredible, I'm smashing it. We're knocking all of our targets out of the park and it's going to be amazing. And I just don't think culturally that's the way that we talk and behave. So we can try and pretend to be that, but I think it's better for us to be our authentic selves than to be a lame version of Americans or others.
Or a watered down version of Australians, perhaps.
Sure, yeah. I mean, Australians have their own version of tall poppy, but they're a lot more brash and outwardly confident, I guess, in those moments where they haven't achieved that success yet themselves. So let them do that.
Is there any connection between tall poppy syndrome and scarcity mentality, in your view?
Explain that to me.
So if you didn't have something and then you saw somebody have something, envy is what we're really talking about.
Sure, yeah, maybe. Although, again, I would just like the examples that I would use as a counterpoint to that are all of those successful people. Like, we don't begrudge those people who are successful in their careers, their success, as long as they are humble in how they celebrate that success and how they attribute that success.
Okay, so you suggested another bit from your book is that you suggested that there is potentially more than enough money in the venture capital space, again, here in New Zealand, but not enough venture, not enough opportunities. That might be contrary to how a lot of people look at this, where, hey, money is the solution, right? We need more money in this space to take off. But that's not necessarily the case in your view. So
the evidence just doesn't support that. Like, there's hundreds of millions of dollars of venture in New Zealand, as we discussed. There's billions of dollars in Australia. If you take an even wider international lens, is effectively an infinite amount of venture capital available to New Zealand companies. And like all of these companies, Xero and Vend especially, were well supported by investors all around the world, despite being New Zealand companies.
Yeah.
So there is no capital constraint in that sense, but you have to be good to attract that capital. And for me, that's the much bigger constraint. I think the people who complain about there being a shortage of capital are often the folks who have struggled to raise capital, and they kind of wish it were easier. And so, yeah, I mean, it's a little bit mean, but I kind of say, don't wish it were easier, wish you were better. I do like to ask anyone who claims that there's a shortage of capital to list off the best companies that they know that have failed to raise capital. And the answers I get to that question are like always underwhelming. Like it's very rare that anyone can point to a genuinely great company that's struggled to raise money. And I mean, even outside of the companies that I've worked on and invested in directly, let's pick a very recent example. So this time last year, Halter, which is a successful New Zealand business in the current generation, raised an $85 million round led by Bessemer, which is a big venture fund in Silicon Valley. That supposedly in the middle of the worst economic conditions that we've sort of had in recent times, they're a great company. Evidence would suggest they've been able to raise a lot of capital.
Right. So if you have something going on, and you're not getting in the way of presenting that to others, what you're saying is that there's a lot of capital out there looking for opportunities.
I think there's only two reasons why you can't raise capital. One is that your price is too high, or the other reason is you haven't told people how good you are yet. And so both of those are on you, not on the environment of how much capital exists in the world.
That's good. Yeah, because I guess one of my thoughts were that when interest rates were on the way up a few years back, when interest rates started to rise, one of my assumptions would be that, okay, the startup ecosystem is probably going to start to really struggle getting capital because people are going to adjust their expectations and demand more certainty for the returns that they're going to get.
Sure, yeah.
We didn't see that.
It sort of happens on the fringes, but I think the explanation for that is that venture doesn't really compete with bonds and equities or whatever. It's just it's another kind of subset of a diversified portfolio of assets at that large scale.
Yeah.
And so, ideally you would have exposure to that through an economic cycle rather than adjusting up and down as a result of interest rates. And I think evidence would suggest sometimes the best companies are founded in the worst moments in terms of the economic cycle.
Build in a bear market.
TradeMe was started in the dot-com bubble explosion. Xero was IPO'd just before the GFC. So you can build great companies even when the economic climate is not super attractive.
Okay. Well, I guess from an investor's perspective, if you're looking for a small component to be allocated towards an asset class that has the potential to give you really strong performance, we're talking about those outsized returns, but we're also talking about negative correlation as well, right? It might zig while the others are zagging.
Yeah,
because it doesn't matter on
also always with the disclaimer, no guarantees, right? That's the full spectrum of possible returns, and that's true of funds. It's true of individual investments. But yeah, if you have the asset base that allows you to afford exposure to that, it can be very rewarding.
Okay, so like again, going back to the start when we were talking about waves crashing, technology waves crashing, and where does that go? If I was to think about the industry that I operate in, which is more financial services and wealth, there is a lot of reasons why it's hard to pass through the gates of traditional finance. And by gates, I mean regulators, compliance. This is how we do things. People that are focused on process more than people or projects more than purpose. And I wonder what's going to happen when technology really starts to disrupt, because there's so much of I don't know what you would call it, but there is a moat of sorts around financial services that is
as a result of that regulation. Yeah,
totally. And technology is going to be the drawbridge, which eventually it's going to collapse. And so there's a systemic risk that concerns me about that when that happens, because it'll happen fast. But then there's an opportunity question that I have around how does one build in, say, a Web3 world? And from someone who's like very, very active in the Web 2, what are your thoughts? Do you think that the next wave of creative destruction could occur in Web 3? Like, I know we've seen versions of it.
Yeah.
Kind of like the
maybe.
internet.
I mean, I feel like Web 3's been around long enough that if that was going to happen, there probably would have been more signs of it happening. But who knows? Maybe it's just a long building wave that's still kind of growing. We thought it was the next one. Maybe it's the N+1. I don't know. Yeah. That's possible. I should add the disclaimer that I haven't invested in any Web3 businesses directly.
Do you want to?
I mean, it's just not a space that I've played in or know
we'll talk
well.
afterwards, Rowan.
I mean, at my heart, I'm a computer scientist, so I have the barrier to get over that the blockchain just feels like an inefficient database to me. But
sure.
But I don't preclude the potential for disruption from those sorts of things for sure. Yeah. And yeah, I mean, I think it's same as I would with any technology. I would say start with the customer problem and work backwards to the technology. I think if you're starting with the technology and trying to search for the customer problem, that's a much harder avenue to take. And so, like, what problems are we actually trying to solve that Web3 are well suited to solve would be the challenge that I would throw back at you.
Yeah, and in the book, I think you mentioned something around the way to approach this as a problem, present solution, ideal solution. Maybe there's also a past, present, and future. Do you want to unpack what you mean by that?
Yeah. So, I mean, I think it comes back to what I was just saying. Like, that's actually a famous Steve Jobs quote, by the way. I'm not making that up. And he was using that defensively at the time when he was reappointed as the CEO at Apple for his second stint. And he kind of came back to a company that had lost its way and become very spread across lots of different technologies. Right. He said, like, we've gotten distracted by the shiny technologies we can be playing with, and we've lost sight of the customer. And I think I see a lot of that in the crypto world from technologists, especially. I don't know so much in terms of finance people. Maybe you have a different perspective of it, but I think there's a lot of people who are really enamored with the technology and what it could possibly do. And they don't spend nearly enough time thinking about the customer and the pains that those customers
I think that was the first, I totally agree. I think that was the first stage. And now it kind of feels like that's scraped away now.
I'm certainly open to that possibility. Like, I'm not a crypto nihilist in that sense, but it may be a long time for that wave to build.
That's a good point.
Because of all the regulatory issues that you described. Just use open banking as an example. Like, I feel like we've been banging our heads against that brick wall in New Zealand for many years with very little progress.
Yeah.
So it's hard to see how those walls are
Yeah.
are washed away.
I totally agree. And I think sometimes if the walls don't come down, you build another city. And that's the city I think that's building. And I think people are going to choose at some stage. Anyway, so
If other people get rich from crypto, I'm not sad.
no, it's good. Well, I think it's kind of good, right? Like the more capital that flows to where there is like genuine innovation happening,
Yeah,
that's when cool stuff happens,
of
right?
course, yeah.
And that's what we've seen in the startup scene.
Yeah,
So
and capital is
yeah,
pretty fungible in that sense. It will flow to where the biggest
yeah.
opportunities exist. So
Yeah, that's right. It doesn't care. Okay, so thank you, by the way, for sharing the book before the release date. When does the book get released
the book comes
officially?
out on Monday, the 24th of February, and it
Okay.
will be available then. You can actually buy it already pre-sales on howtobewrongbook.com, and it'll be available in bookstores and other things from the Monday the 24th.
Howtobewrong.com.
Howtobewrongbook.com.
Howtobewrongbook.com. Check it out. The way that you've written this book felt like you were talking to me, like me personally,
Oh,
and
thank you.
like to an everyday person who I could understand it, right? And there's a lot of jargon, there's a lot of industry stuff, there's a lot of stories and people that you can easily get disconnected pretty quick when you're reading books. But I really felt like you were talking to people that need to hear it,
Yeah.
if that makes sense. So, like, what is your audience here, and what are you trying to achieve?
I mean, firstly, that's great. I love to hear that review. So thank you. I mean, I say in the intro that I use the expression "we" a lot during the book. And that's intentional because so many of the lessons that I'm describing in the book were first conversations that I had with actual founders or with other people that were asking for advice or help with the businesses that they were working on. And so, all the way through these companies that I've had this great opportunity of working with, I've been sharing these lessons with a small audience of people. And what I realized a couple of years ago is that there's actually a much larger audience of people who are interested in these questions. They like to know the stories of these companies and how they grow and how they contribute to our economic prosperity. Like the government talks a lot about this. We talk a lot about it as a path to our future success. And yet there's this huge mythology that's wrapped around these companies and startups, especially. There's, the stories that you hear are often the airbrushed versions of the stories. And for me, that's a real shame because it skips over all of the interesting bits, all of the things that I learned, I guess, working on these companies, the things we got right, small number of things we got right, and the much larger list of things that we got wrong, but learned from that gave us scar tissue that made us better. And so, yeah, my hope with this book is that I'm able to reach a much larger audience of people who are interested in these questions and inspire some of them to think differently about how these companies contribute and hopefully even to be inspired to work on and invest directly in these companies.
Yeah.
If more of us did that, then we'd actually achieve those economic outcomes that we all hope for.
Yeah. So, really, you're trying to create wealth.
Yeah, I mean, I think we've proven that we can do that in New Zealand. These 4 stories that I tell in the book are great success stories, and we've proven that we can do it at that scale. And so, why not more? Like, what are the actual constraints to us doing that at a much larger scale? And I mean, my answer to that often comes back to people. Like, we just need more people to realize that potential and to work directly on these companies, and then the ecosystem will continue to grow.
Awesome. Thank you for what you're doing out there as well. And all the best for the next steps.
Thank you very much. Cheers.